Hello and welcome to this bite-sized Astranti video. What you see on screen right now is an extract from our F3 video on debt finance, and more specifically here, the types of debt finance you might be expected to know for your CIMA exams. Now, this topic is important at F2, F3 and in the MCS and SCS exams, as you will be expected to know and apply debt finance for a particular business scenario. So let's take a look now, shall we?
What we'll do in this section is look at these two general topics first. And what kind of debt finance can we get from a bank? Well, firstly, we can, of course, get bank loans. Now, I'm sure many of us here have loans, and really what a loan is a specific amount of funding for a set period of time. Now, this can be at either a variable rate, which means that the rate of interest changes with the market, or it can be at a fixed rate. So the entity can say, I want to borrow X amount for X amount of time, and the bank would say, okay, well, your interest payments are going to be this much every month until the debt is paid. There wouldn't be any changes with the market. Now, most loans are secured, and that's just because banks really want a guarantee that they're going to get their money back, although it's not always the case, and some loans can be unsecured loans. Although, as we saw in the previous section, if the loan's unsecured, the interest rate or the rates of repayment are going to be higher to compensate the bank for their higher risk taking. Now, what are the advantages of a bank loan? Well, they're really simple and easy to arrange, and are really the most common type of debt finance, especially for small and medium-sized companies. They can also be really flexible when it comes to the terms and conditions of lending. Another advantage is that normally the loan can be paid off at any time during the agreement with minimal warning. But as we've already said, variable rate loans mean that interest rates can change. But loans aren't the only way the banks can offer debt finance. Another facility is the revolving credit facilities, or the RCFs. Now, RCF is a bank facility, and what it does is that it allows a borrower to withdraw funds up to an agreed credit limit. Now, the funds available from an RCF vary as the funds are borrowed or paid, much as we would pay our credit cards. Now, they're really flexible debt financing options because they allow an entity to minimize their interest payments because they're only having to take out loans for what they need. Now, a common type of RCF is a bank overdraft. And the next offering from a bank is international debt finance. Now, this is for larger entities, and it means they're able to borrow funds in foreign currencies as well as their own domestic currency from banks based at home or abroad. Now, foreign currencies would normally be used to fund foreign investment projects or a foreign subsidiary. Now, the reasoning behind this is that the foreign currency debt is then able to be serviced via their foreign project or their foreign subsidiaries' cash flows. Now, this helps that entity mitigate any adverse movements in exchange rates because it's the foreign currency that's paying the currency interest. So that entity is not having to always convert back into their own home domestic currency and expose themselves to risk in fluctuating currency markets. So let's have a look at an example to make sure we're nice and clear. Let's imagine we've got a US company that is paying off a €1 million loan using returns in euros from a European product launch. So we know this American company is operating in Europe and they've taken out a European debt finance. Now, of the €2 million of earnings, they've had to pay 1.1 euro millions back for the loan and the interest. Now remember, this is all in euros because the debt was taken out in euros. This means the US firm has to only convert 900,000 euros back into dollars. Okay, now let's imagine the US company borrowed the full $2 million in dollars at the beginning of the project. They would then have had to convert it into euros at the start of the project, and then the full 2 million euros of earnings would have to be converted back into US currency to pay the US debt and, of course, for their earnings. Now, this means they've set themselves up for higher risk because they're having to convert a higher amount back into dollars. So, of course, if the currency market has fluctuated adversely, this will have cost them a significant amount. Okay, so there we go. That's bank finance, just noting that borrowing in dollars is risky. Let's move up, and now we're going to have a look at capital market finance. Now, what we're first turning our attention to with capital market is debenture. Now, debenture is also known as bond or loan stock, and they're medium to long-term debt instruments that are issued by large entities to borrow money. Now, the debenture is offered to potential buyers via the bond market. Now, the bond market is part of the money market where debt can be bought and sold in a similar way to how company shares are bought and sold. Now, what happens is generally the company would offer a bond at one price, say for example £100, and then would repay the investor at a higher price, say £120 sometime later. And then this is the incentive for purchasing bonds. Debentures are like loans because the company still has to pay a specified amount with interest, and they're normally secured on company assets. Debentures are freely transferable by the debenture holder and can be traded on an exchange such as the bond market, but they don't have any rights, this is the holders, to vote in the company's general meetings of shareholders, but they can have separate meetings or separate votes to decide matters such as changes to the rights attached to their debentures. Now, a debenture can also be sold through a private placement instead of being offered openly on a market. Now, the interest rates offered on bonds generally reflect the risk an investor is taking by purchasing the bond. The higher the rate, the riskier the bond, just as we saw with banks in the previous section. Okay, so that's debentures. What we're going to do now is have a look and see how they work, and we're going to use a hypothetical company called Go Faster. Now, they're a medium-scale car manufacturer who are looking to replace finance for more efficient equipment. Now, they offer their bonds based on the following terms. A 5-year bond offering investors an interest rate of 5%. The bond requires an initial minimum investment of £1,000, and the debenture is available between the 1st and the 14th of April and then the year X6. So the face value is also known as par or nominal value, and this is the price paid for the instrument by investors. Now, we know for Go Faster that has to be £1,000 and above. The interest rate to be paid by the company to investors can also be known as the coupon rate, which for our example is 5%. And then we have something called the redemption date or the maturity date. And this is the date by which the company will pay the investors. So here we have the 14th of April X6. So there we go. That's our example. Let's just show you some extra terminology. What we're going to do now is look at a different kind of debenture, which are convertible debentures. Now, they are debentures which, as the name suggests, can be converted. Now, they can be converted into equity shares of the issuing company after a certain amount of time that was predetermined. Convertibility is a feature that companies may add to the bonds they issue so they become more attractive to investors because, of course, then the debt holder has the opportunity to make a profit if the entity's share prices rise significantly. Now, because of the advantage a buyer gets from the ability to convert, convertible bonds typically have lower interest rates than non-convertible corporate bonds. So now let's move on to something called commercial paper. Now this is an unsecured short-term loan note, and it's offered by an entity to potential buyers. Now it's basically an IOU, and they're generally used in place of cash at the request of the payee and are considered legally binding until the full amount has been repaid. Now they are a fixed maturity, 2 to a maximum of 270 days, and a typical maturity ranges from 1 week to 3 months. The longer the maturity on a note, the higher the interest rate the entity pays. So a commercial paper is a discount instrument. So it's sold at less than face value, and then it matures at face value. So for example, it would be sold at £80 and then redeemed at £100. Now there's 2 ways that returns can be produced from a commercial paper. The first is through a coupon, so that's basically another term meaning interest payable, or as you can see on screen, a zero coupon option. Now what zero coupon means is that the investor gets no actual periodic payments, and the rate of return on investment is only returned by the difference between the purchase and maturity. So in our example of sold £80 and redeemed at £100, it would be the £20 increase, the difference between 80 and 100. Now, commercial papers can be traded on an exchange at any time before their maturity date. However, the sale price is decided by many factors, including interest rates and, of course, how well the market believes the company is going to perform. But commercial papers are unsecured, so they're normally only issued by large entities that have a good credit rating, but they can also be issued through dealers.
Well, I hope you enjoyed this video, and if you want to view more content like this, including mocks, revision notes, and even question tutorials, you can head on over to the Astranti website, where we offer a full course that gives you access to this wide variety of materials and more to help you pass your exam. Now, if you'd like to get in contact with us and see more posts like this, you can subscribe to our social media channels, which include Instagram, YouTube, Facebook, and Twitter.